Well,
Pleasure.
Evercore ISI comparing the bank stress to another scary time on Wall Street, the savings and loan crisis and the crash of '87. Julian Emanuel is the firm's senior managing director at Evercore ISI. Julian, great to have you here on set. Steve was just saying, is the bond market pricing in too much versus the equity market pricing in too? I mean, where should the two meet at this point?
So the problem here, Melissa, is if you think about where rate expectations are right now, we've just talked about it, somewhere between 3.75 and 5.25. So how can we possibly know? And the fact is until we get more clarity, and I hate to use the word data dependency, but we need to see data. But more than that, we need to see how the market responds to the data. Obviously, we won't have to wait too long for that inflation number tomorrow. But the thing is, when you think about it, no one really can make solid assumptions given that kind of variability, and that's why you're seeing the volatility in the equity markets.
Let's say Fed funds are right. Let's say we end the year at around 375. Is that good for equity markets or bad for equity markets?
So our view is it actually could be both, and let me explain. Okay. Because if what we've seen in the last week is the first shot across the bow in terms of the effective tightening, we are going to have a recession. That is Ed Hyman's forecast. We do think it's likely to be mild. And so, therefore, what we're thinking is you're going to get a retest of those October lows, but eventually get that buying opportunity that we've been waiting for almost 2 years now that will launch the next bull market phase.
So, Julian, I think that the data is out the window. I think that the only data that we care about right now are banks collapsing and the further collapse of banks. So I think that's taken a very distant backseat, and Tim brought this up. The market has tightened around this more than anything the chairman can do at this point going forward. So should we even pay attention if that number is hot tomorrow? Does it really even matter?
Well, we should, because I go back to last Tuesday, and you think about the uncertainty. To think that you would see financial stress of this kind develop in the system 24 hours after Chair Powell suggested he might go 50 on the 22nd, it just tells you how extremely uncertain the environment is.
But that wasn't as a result of the Fed, right? That wasn't what the market has done over the last couple of days. SVB ran the market really on the same day in the afternoon. So I guess my question to you, though, as a market strategist, is has this only elongated this whole process? Everyone wanted this bear market to, and even the Fed, to be aggressive and quick and over with. But when I look at where we still don't know where we are on credit, I look at standards for banks. Again, I think they've tightened immediately, and I think the impact on the economy is something we don't know. I think it's another headwind to the economy. I guess it's a long way of saying we wanted this thing to be over with in a year. I think the events of the last 3 days have only extended the timeline for people to say all clear for another 12 months.
I differ on that. I think really, if you look at it, we were having conversations last week with clients out of all places on the West Coast, talking about how the no landing scenario was operative, talking about the idea that rate hikes were no longer able to have the kind of monetary transmission mechanism that they've had for the last 50 years. All of that's out the window. And I would suggest that, again, and look, part of the end game is we do want to see enough of a downturn to make stocks attractive, to cause this, cathartic moment where we can reset and multiples can begin expanding as the economic cycle turns. But we're still a ways from that. However, I would suggest, whereas people were thinking, well, this could last into 24, it does feel like the downturn is closer than we thought a week ago.
We talk often, Julian. You're on the show. You're on CNBC a lot. I don't think that there would have been a time where if somebody had asked you, what's the next tape bomb you see, that you would have said Silicon Valley Bank shares or run on the banking system, right? So I'm wondering, like, now that you think out in terms of the ramifications of Fed tightening and where we could see further cracks in the system, what's on your radar at this point?
I think the next thing that we really need to be cognizant of is how credit in general trades. one of the hallmarks of the last 9 months is that credit was very well behaved once we figured out that Europe wasn't going to implode over the summer. We've seen some widening over the last week or so, but nowhere near commensurate with the kind of moves we've seen in regional banks. We'll be looking at that very closely for signs of stress in the system.
Julian, thank you. Good to see you. Julian Emanuel, Evercore ISI. That's something that you've been following. I mean, are we whistling past the graveyard when it comes to credit and how relatively behaved it's been?
So the HYG, on a day that the yield curve moved the way it did, right, you would think it would be up. And in fact, it was up earlier in the day, but it closed down, telling you that spreads widened, and they widened even more because rates went up. But not even close to a warning sign or a flashing light at all. So I'm staying short that and the LQD.
So I understand the debate around what the Fed has done and what type of activity that has encouraged, right? We've had loose monetary policy for quite some time. Now we're tightening, and there are going to be some things that break. But to Tim's point, the Fed's not responsible for risk management and oversight within a singular institution. That is up to you to determine as a shareholder, as an investor, and as, you know, a C-suite executive there. And then what you mentioned about credit, as long as credit stays, I think you're looking at Fed funds and you're looking at this quick pivot. Credit is where the Fed is going to continue to focus. And as long as that stays in line, I think we're getting ahead of ourselves in terms of like
high yield spreads have widened 65 bips in 2 days. I mean, so
65 bips, but
again, credit happens fast.
Yeah,
but we're nowhere close to the north of 10 or 11. What are we, like 8.75, 9 in terms of high yield spreads? I mean, high yield returns. We have a long ways to go, 200, 300 basis points before you start to kind of hit that panic button.
Banks are extremely well regulated, right? Someone would posit that they're perhaps over-regulated. And somehow this still happened. And so I understand and I completely get your point and agree with it in terms of it was that bank's responsibility to manage their risk. But at the same time, when you're in a crisis of confidence, you think this is a regulated system. How can the regulators? There's no feeling of a safety net here. And I think maybe that is part of the reason this whole thing is like a vortex.
No one thought, and I think Karen brought this up. No one thought you had to worry about in Signature that 90% of the deposits were above the FDIC insured level. So that's the one thing that's glaring going forward. But usually what regulators do is they'll fish around and they'll change a bunch of other stuff. With the Fed, though, they are responsible for the long and variable lags to understand that.
But sorry. Well, I hear you, but if I have concentration risks as a portfolio manager and I'm invested all in one sector, I'm going to have risk committees all over the place tapping me on the shoulder saying I'm not allowed to get as much. So and when you talk about also the collateral that's now eligible to be pledged at this BTFP, what are we talking about? And this is a thing that maybe we still don't know, because there are mortgage-backed securities that are more esoteric and bizarre, even though they're based on government securities. What's allowable? And if that's allowable at par, I think we're letting people off the hook.